Hey guys, welcome to my channel. In today's video, I'll be sharing with you one of my favorite bullish strategy, and that will be the diagonal spread. If you have been following the weekly trading videos that I post every Sunday, you would have realized that the diagonal spreads actually form quite a significant portion of my options portfolio. So in today's video, I'll be sharing with you in detail how I enter, exit, roll, and repair my diagonal spreads. Hopefully, you will find today's video useful. So let's get started. So the diagonal spread is basically a two-legged strategy. It is a slightly bullish to bullish strategy, and I typically enter the diagonal spread when I'm bullish on a stock and I expect the price of the underlying stock to increase over the next couple of weeks or months. So the first leg of the diagonal spread involves buying a deep in the money call option, and the second leg involves selling an out of the money call option that has a nearer expiration date than the in the money call option that you just bought. So take, for example, the price, let's say, for example, the price of Apple is at $125 as of now. So if I intend to enter a diagonal spread for Apple, I will buy a long call that is expiring on the 19th of November 2021, strike price of $115. And at the same time, I will sell a short call that has a closer expiration date, which is the 2nd of July 2021, strike price of $130. So the next question you might ask is, why do I have to make things so difficult? If I'm bullish on a stock, why not just buy a single call option? So as you know, as an owner of a naked call option, time works against you. The time premium or extrinsic value of a naked call option decays for as long as you hold the call option. So in essence, you're actually losing money every day while waiting for a price rally that may or may not happen. However, if you enter a diagonal spread and you execute one correctly, it is actually a theta positive trade because of the out of the money call option that you just sold, which means time is in your favor. You get paid by the time decay of the short call while waiting for the stock to rally. And that's really the beauty of the diagonal spread, because based on whatever technical or fundamental analysis you have done, you may be right about the underlying stock going up. But when exactly will the price rally? Nobody knows. It might be next week, 1 month, or even 3 months later. So the really good thing about the diagonal spread is that you get paid while waiting for the price to rally and still get to enjoy the upside when the price rally actually happens. Of course, there's no free lunch in this world, so in exchange for the positive theta, the upside for the diagonal spread is not unlimited and capped at a certain point. If you take a look at the P&L chart of a diagonal spread, you can see that you get to participate in the upside up until a certain point at which your profit starts to plateau. That being said, you can always close the short call and convert the diagonal spread into a naked long call position if you're extremely bullish and want to participate in the full upside. I will talk about this in the later slide. So how do I normally enter a diagonal spread? So for the long call option of my diagonal spread, I usually select the contract that has a strike price of between delta 70 to 80, and I usually select the contract that is at least 3 to 6 months before expiration. So the question you might ask is, why a range of 70 to 80 delta? So the higher the delta of the call option, the more upside you get to participate in. So if you're really bullish, you will go for the call option with delta 80, but that also means that your call option is more expensive and the broker will block a higher capital from your buying power. And why do I choose a call option that is 3 to 6 months out? Remember, the closer you are to expiration, the faster the time decay works against you. So by buying a call option that is at least 3 to 6 months out, you are making sure that you give time for the trade to play out. Of course, one of the other consideration is the cost. Deep in the money delta 80 calls are already very expensive, and it will be even more expensive if you buy it out further in time. So you really need to try different combinations and balance the different risk to reward ratio you're comfortable with. So for me personally, the long call of my diagonal spreads usually have a delta of 70 to 80, and I always make sure to buy it at least 3 to 6 months out. Moving on to the short call leg of the diagonal spread. So typically for the short call, I will select the strike price at the key resistance level, and the contract I will usually select those that are expiring at least 1 to 2 weeks out. So why do I select the strike price at the key resistance level? The explanation behind this is because I want the out of the money short call to expire worthless by the expiration date, so that I get to keep the entire premium of the short call. So that's why the diagonal spread is actually a very powerful strategy. Even if the stock goes sideways for the next couple of weeks or months and the stock price doesn't rally at all, you can actually still make money from selling the premiums of the short call for as long as you are in the trade. I'll be showing you guys a demo in Thinkorswim after this slide, hopefully to give you a better understanding. So for the short call, I will also usually select the contract that's expiring 1 to 2 weeks time, simply because that's when the time premium decays the fastest. Last but not least, for whatever combination of short and long call you choose for the diagonal spread, you should always ensure that the theta for the trade is positive so that you can get paid while waiting for the price to rally. So I'm just going to do a very quick demo on the Thinkorswim platform. The stock that I'm looking at is actually the Taiwan Semiconductor, ticker symbol TSM. So if you follow my weekly options trading game plan videos, this is actually one of the stocks that I mentioned that I'm very keen to enter a diagonal spread position for this. So if you look at the charts of TSM, you can see that TSM is actually on a very clear uptrend. Prices are trending upwards, and also you see the different moving averages going up very nicely. And right now prices are finding support at the key support levels. So the green line over here is actually the 150-day moving average, and we have the blue line over here is the 50-day moving average, and also the pink line over here is the 20-day moving average. So prices are actually sitting very nicely on key support levels, and this support is likely going to hold for TSM, and the stock is trending upwards. So I'm actually quite bullish on this stock in the next couple of weeks or months. So diagonal spread is definitely one of the trades that I can enter for TSM. So if you look at the charts, the next key resistance level for TSM is likely going to be around this 121, 122 price level. And identifying the key resistance level is important because that's the strike price that you will need to enter for your short call. So I actually have another YouTube video. I made another YouTube video where I share with you guys on how to identify key support and resistance level. So I'll leave a link down in the description below. So do check it out so that you can correctly identify the key resistance level when it comes to the diagonal spread. So coming back to the chart, just keep in mind the 121 and $122 price level. So that's likely going to be our strike price for our short call. So moving on to the option chain for TSM. So this is a list of option chain available for TSM. Today is the 13th of June. So I'll start off with the long call position of the diagonal spread first. So if you recall in my earlier slides, I did mention that for the long call position, I will typically select the option that is at least 3 to 6 months out. So 3 months out, that would be at least 90 days. So that would be the 17th of September. That's at least 3 months out, 96 days left before expiration. So if I scroll all the way down, I can see the entire list of options available. And if you recall in my slides, I mentioned that I will typically select the strike price that has a delta of between 70 to 80, depending on how bullish I am on the stock. So in this case, I'm actually pretty bullish on TSM simply because if you look at the charts earlier, you can see that the charts of TSM is actually trending up very nicely. All the moving averages are also trending up very nicely, and right now prices of TSM are actually sitting on very key support levels. So I do expect price of TSM to actually go up in the near term. That's why I'm actually pretty bullish on TSM. So in this case, I will likely just select the strike price with a delta of 80, and that happens to be the strike price of 105. I'm going to click on buy here, and you can see that the option is populated over here. And now I'm going to go back and select the short call option. So if you recall in the slide, I did mention that for the short call, I would typically select the contract that is at least 1 to 2 weeks out. So in this case, I actually have two options. I can actually select the call option that is expiring on the 18th of June, which is a Friday, and I have 5 days left for the trade, or I can select the option that is expiring on the 25th of June. That's 12 days away. So in this case, I will likely select the contract that is expiring on the 25th of June, simply because I don't think if I select the 18th of June, there will be much premium for me to collect. So I'll go ahead with the 25th of June. And if you scroll all the way down, so right now, how do I select the strike price of my short call? If you recall in the slides I mentioned and early on when we look at the charts of TSM, one of the key resistance level for TSM, the next key resistance level is likely going to be the strike price of 122. So the price level of 122 is likely going to be the next key resistance level for TSM. So in this case, I'm going to select the short call with a strike price of 122. I'm going to hold the control key and press sell over here. So right now you can see that the diagonal spread is actually populated very nicely in the bottom here. So I want to analyze my trade. I will go to the risk profile over here. So moving on to the risk profile of the diagonal spread, you can see here from the charts that my max loss for the trade is at around $1,416. My max gain for the trade is at around $283, and that's because I have a short call position that is limiting my gains. So if you recall in the earlier slides, this is actually one of the trade-off. In exchange for the positive theta, you are actually capped on the amount of upside that you have. So in this case, anything above the $122 price level, you can start to see your profit getting eroded. And that's only up until the 25th of June, because remember your short call expires on the 25th of June. So let's say if I move on to a date after the 25th of June, let's say I move on to 28th of June over here, you can see that my diagonal spread actually becomes a long call position, simply because my short call has already expired. Okay, so the key thing about the diagonal spread is that you want to select the short call that is at the key resistance level, so that hopefully the short call will actually expire worthless, and then you can keep the entire premium. So the idea behind the diagonal spread is that you'll continue to roll the short call. So every time when it's close to expiration or when there's no extrinsic value left in the short call, you will want to roll the short call for as long as possible, likely 1 to 2 weeks out again, and at the same time selecting a strike price of at the key resistance level, so that hopefully you can get to collect the premium again for the short call, and it will expire worthless. So I'll talk more about this in the later slides when I talk about rolling and repairing trades for the diagonal spreads. So moving on to the next section, that will be rolling the short call. Remember, the key idea behind the diagonal spread is that you want to roll the short call for as long as possible until a significant price rally happens, and you're always hoping that your short call will be out of the money close to the expiration date, so you get to actually keep the entire premium of selling the short call. That way, you can continuously make money rolling the short call while waiting for the price rally to actually happen. So when do I typically roll the short call? I typically roll the short call when it's close to expiration, when the short call has little extrinsic value left, making the entire trade theta negative. Later on, I'll be showing you a simple Excel spreadsheet that I use to keep track of my options portfolio. And from there, you have all the information of your options position all in one place, including the total theta of the trade. So similar to the earlier part of the video on the short call, I typically roll the short call to a strike price that is at a key resistance level. That's because I'm hoping for the short call to expire out of the money again, and I can repeat the same steps rolling the short call. And I always roll the short call to the contract that is expiring 1 to 2 weeks out, because that's when the time decay actually happens the fastest. And last but not least, when I roll the short call, I always want to ensure that my diagonal spread remains theta positive after rolling the short call, so that I can get paid while waiting for the price rally to happen. So this is the spreadsheet that I use to keep track of my options portfolio. As I mentioned earlier, it's actually quite hard to keep track of your options position, especially for diagonal spreads, because you keep rolling the short call. So, and that's because when you roll the short call, you close off, let's say for example, in this Pfizer position, right? You close off this particular contract that has expired on the 11th of June, and you roll it to another one that is expiring on the 25th of June. But this particular, the first line of contract that you have rolled and closed doesn't appear in the P&L on your trading platform. So there's no way for you to like automatically keep track of the entire P&L for the entire diagonal spread trade. So the only way is to manually add them back, add the P&L of the short call plus the existing open positions, the P&L of the existing positions that you see on the trading platform. And that can actually be quite tedious, because if you have multiple diagonal spread trades and you roll many short calls for each of them, it's actually quite hard to keep track of your entire P&L in one place. And typically, for example, say you want to close or exit the trade and you're not too sure whether you have actually made a profit for the diagonal spread, and you try to manually calculate them. By the time you manually calculate the total P&L for a trade, the prices will have already moved. So having this spreadsheet here is actually very beneficial. So I've actually made a YouTube video. I'll post a link down in the description below. So this is actually a Thinkorswim RTD. So this Excel spreadsheet actually retrieves live prices from Thinkorswim. So when you open this spreadsheet during market hours, you can actually see the prices change accordingly, and this will reflect the real true live P&L of your whatever trades that you have over here. So I'll put a link in the description below and you can always check it out. That video, the YouTube video that I did, also has a link to a template of the Excel spreadsheet where you can download it for free. I've left it in the description below as well. So coming back to the example that I gave in the earlier part of the video where I did a live demo on Thinkorswim, if I have entered the diagonal spread on TSM, I would have entered an entry on my spreadsheet, something that looked like this. So today is actually the 19th of June. It's actually 1 week after I recorded my demo on Thinkorswim. So if I've entered the diagonal spread on the 11th of June, the current trade will actually look like this. The current P&L is showing a negative $76. And if you recall in the demo, my long call of the position was actually a strike price of $105, with the contract expiring on the 17th of September. And for the short call, which is over here, is actually the strike price of $122. And this $122 is actually the key resistance level. And with the contract expiring on the 25th of June, which is 1 week later. So as I mentioned earlier, this spreadsheet actually gives you an easy way to keep track of your entire position. So you can actually take a look at the total delta over here, which is the sum of column K over here. And the total theta is displayed here as well, which is the sum of column L over here. So right now, if you look at the current situation I have for the diagonal spread, my trade is actually theta positive. So there's actually not much left for me to do, because I still have 1 week left before the contract expiring. You can see that the price of TSM as of Friday's close is at $115, which is still quite far away from my 122 strike price, and I still have 1 more week to go. And looking at the what premium or what value is there left in my short call contract, there's 21 cents left out of the 90 cents premium which I sold initially when I opened the short call. So there's still quite a fair bit of value left, or extrinsic value left in my short call, and 1 week left before it expires. So definitely I will not take action. Closer to expiration, probably on Thursday or Friday, I would see the theta become negative, and that's my indication or my signal to actually roll my short call to another further out, 1 or 2 weeks out. And at the same time, I will be looking at the strike price to see where is the next key resistance level. And likely later on, when we take a look at the charts of TSM, you will see that for this week, prices actually hit close to the $122 price level before coming back down again. So selecting your strike price at the key resistance level is important, because that's likely the positions where price will not go above that, and likely you will get to keep the entire premium for your short call. So coming back to the charts for TSM, you can see that 120 last week prices actually closed at around this level on the 11th of June. And this week when market opened, these are the 5 trading days that you see over here. It actually hit close to the high of $121.63, so close to the $122 before coming back down again. So that's why you should always select your strike price at the key resistance level. So it will likely expire worthless, hopefully by the end of next week, and I will roll the short call again. So moving on to the next section, that will be repairing the diagonal spreads. So for the diagonal spreads, there's actually not much you can do when it comes to repairing, especially when the trade goes wrong. So there's actually 2 scenarios that can happen that will force you to repair the diagonal spread. The first scenario is when the price of the underlying stock plunges significantly and the short call actually has little extrinsic value left, making the entire trade theta negative. So in such a situation, if you decide to stay on the trade and because you feel that, oh, okay, the price will actually recover in the near term and there's actually some additional bullish upwards momentum that you see in the stock, you can continue to stay in the trade. So what you will do is you actually roll the short call. So what strike price and what contract that you roll to is very similar to how you roll the short call, as I mentioned earlier in the earlier slide. And the next scenario is actually when the price of the underlying stock rally very significantly and your short call becomes deep in the money. So this is actually one of the more dangerous situation, I would say, because when your short call is deep in the money, and because remember your short call, you always roll it to something that is 1 to 2 weeks out. So if your short call is deep in the money and is close to expiration, there is a chance that you might get a sign. So typically for such a situation, when my short call is deep in the money, let's say delta 80, there's 2 ways that I can go about doing it. I can either roll the short call, that means I roll out to a further, the contract that is further out in expiration, and I select a much higher strike price. Hopefully by the time the further out contract expires, it's still out of the money. Or the second method is I can actually close the short call entirely. So this entire trade becomes a long call position, and this you only do this when you're actually extremely bullish on stock, because remember, if you only keep the long call side of the diagonal spread, you're actually hurting from the time decay of the diagonal spread because you don't have the short call to compensate for the time decay. So that's pretty much the 2 situations that you have that will force you to try and repair your diagonal spreads. So moving on to the last section of the video, that will be how to exit the diagonal spread. So there's actually quite a number of different situations that can happen that can actually force you or signal you to exit from the diagonal spread. So the first scenario is actually when the long call has less to 1 month to expiration, or you can no longer roll the short call to make the trade theta positive. And if you recall in the earlier part of the video when I mentioned you enter the long call that is at least 3 to 6 months out, and that's because you want to give time for the trade to play out. So closer to expiration, actually time is actually working against you and your long call actually decays a lot faster. So at some point in time, your short call can no longer make up for the time decay of the long call. And it makes sense for you to close the diagonal spread. So if you're still bullish on this particular underlying stock and you feel that, hey, there's still upside for this particular stock and you want to remain in a diagonal spread, you can always close this diagonal spread and open a new diagonal spread that is 3 to 6 months out, and that gives you a lot more time for the price to rally. And you can do this over and over again, collecting premiums along the way. So moving on to the second scenario where you actually exit the diagonal spread, that's when prices rally significantly. So this scenario is actually pretty similar to the scenario I mentioned earlier when I talk about repairing the diagonal spread. So when prices rally significantly, and if you choose to continue to stay in the diagonal spread, you can always repair the trade by either rolling the short call, or you can close the short call and just keep the long call portion of the diagonal spread and continue to participate in the upside. But there also comes a situation where the price rallies so significantly that you actually have to pay quite a hefty premium to roll the short call. So when prices rally significantly, your short call becomes deep in the money. So in order for you to roll the short call, you have to close your existing short call, which involves paying a huge debit to close a short call. So in such a situation, I will typically close the entire diagonal spread. So if you look at the P&L chart of a diagonal spread, when prices rally significantly, your diagonal spread trade will definitely be profitable. For diagonal spreads, you get to participate in a significant portion of the initial price rally up to a certain point where your profit will start to decrease slightly if the stock price continues to move higher. But either way, when prices rally significantly, you can always close the entire trade for a profit and wait for the opportunity to enter a new trade. Any profit is always a good profit. The third scenario where you exit the diagonal spread is when prices plunge significantly and you hit max loss for the trade. When it comes to trading, always have an exit plan before you enter any trades, and always stick to your game plan and predefine stop loss. And the last scenario is when prices plunge, breaks the key support level, and the uptrend is no longer intact. In such a scenario, you might have not hit your max loss for the trade yet, but it is clear that the trend of the stock has reversed. So it will be good to exit the diagonal spread entirely. You can always wait for better opportunities to re-enter the trade. In such a scenario, there is a possibility that you can actually close the trade for a profit even though prices have plunged significantly. Because remember, you have been rolling your short call and collecting premiums along the way. So that's really the beauty of the diagonal spread. If you have been collecting premiums consistently by rolling the short call multiple times, you can still potentially exit the trade for a profit even if prices turn bearish, because the decline in the value of your long call would be offset by the premiums you have been collecting rolling the short call multiple times. So that's pretty much all you need to know for the diagonal spread. I know all this sounds very theoretical because it actually is. Nothing can beat the real world experience you get when you start trading with real money. So if you're new to trading options, I would definitely recommend that you start paper trading with the Thinkorswim platform first, just to get yourself familiar. If you enjoyed watching this video, be sure to like and subscribe. I also post my weekly options game plan every Sunday where I share with you the trading opportunities for the upcoming week. Happy trading and thanks for watching.